Investors, we have totally forgotten all of the fundamentals of dividend investing. These shiny, high-yielding income ETFs have totally warped investors' brains and have set unrealistic investing goals, and unfortunately, I have a feeling some of you are going to be learning the hard way. Delaying instant gratification, that is the key. Let's get into what investors should always remind themselves when making an investment. Should always be skeptical and should always be looking for these red flags. So, first question you should be asking yourself, if it's this easy, why isn't everyone just doing it? If TSLY is offering a 60% dividend yield, why isn't everyone just dumping their money into this fund and getting an absurd return every single year? Did Elon Musk become the world's richest person by investing in TSLY? No. He became wealthy from being a shareholder of Tesla and Dogecoin. So ask yourself that question. If getting rich is easy, why isn't everyone else just doing it? You also have to be aware if returns are too good to be true. The typical return of the S&P 500 throughout the decades is 7 to 10%. Anything over that, you really have to ask yourself, how are they doing that? If somebody is offering you 30 plus returns, you have to wonder, why don't they just keep those secrets to themselves and get rich by themselves? Also, be careful of anyone who guarantees you a return. That's a huge red flag. A common sign of a scam is someone will offer ridiculous returns and then also guarantee them. Nothing is guaranteed in this life, especially not in the stock market, because nobody knows what's going to happen tomorrow, let alone years from now. Younger investors, or basically anyone that isn't close to retirement, which is the vast majority of my audience, you should be focusing on growth right now, not dividends. Dividends are just gravy on top. They are not free money. They come from a portion of the company's earnings, or with income ETFs, they come from premiums earned doing options trading. All that's happening is money is being transferred from the company's pockets to your pockets, while at the same time a portion of that paycheck is also going to Uncle Sam's pockets, which then in return is going to Ukraine's pockets. So when a dividend gets paid, the stock or ETF price goes down by the amount of the dividend, since the company is now less valuable. This happens all the time. Look at any stock chart on the day of the ex-dividend and you will see that drop off. That's not to say that the share price will never recover, as it often does, otherwise none of us would be dividend investors. And I should have put a trigger warning at the start of this video, but I don't need you to love me. I understand this video will upset some people. I want to make sure you're not just surrounding yourself with a bunch of yes men, a bunch of people that you will agree with or think just like you. That's a guaranteed way to lose money, is if you're just surrounding yourself with people that will not challenge you, that will not make you better. You need to be having conversations with people that have differing viewpoints. Get out of those echo chambers. Let's talk about dividend yield. Dividend yield is not the most important thing when it comes to investing in a company. Whether or not a company can grow its earnings over time, that is an important factor to consider. How do the financial statements look? Does the financial health look okay? What's the profit margins? What sector are they in? Do they have a competitive advantage? Do they have any moats? How are they doing with dividends and share buybacks? These are all important questions to ask. These are the questions that the Warren Buffetts, the Ray Dalios, these are the questions that they ask. It's not just, let me gobble up as many high-yielding dividend stocks as I can. Now, I actually personally prefer companies with a lower starting yield as long as their dividend growth rate is high. A company with a 1.5% yield but a 20% CAGR is going to have some insane returns over the years via yield on cost. While many are asking what is a woman these days, others are asking what is a high-yielding dividend stock. I would say for me, anything about 3.5% is a high-yielding stock. Now, I know a lot of you are laughing right now because of the oversaturation of income ETFs that are offering 12% plus yields. That has really distorted people's perceptions of what a normal yield is these days. These 50 to 60% yields we're seeing these days, that's probably not sustainable in the long run. And that's probably coming at a hidden cost, such as high expense fees or a decline in share price over time. Another question I often get is If you have a $155,000 portfolio, why don't you just invest it all into TSLY or another income ETF? You would have like 11,000 shares that would earn you $8,000 in passive income each month. Why don't you just do that, you idiot? Well, like most people these days in the instant gratification era, they're only thinking about the best case scenario. The best case scenario being TSLY will always give out these juicy yields just because they have done so for the past year. They never take into account the worst case scenario. What if the volatility goes down, which will then cause the monthly dividends to go down? What if my investment principal goes down and I have to take a loss if I want to exit? These are questions and risks wealthy people ask and analyze because they care about protecting their investment first, then they ask, how can I grow it? Versus what I'm seeing a lot these days is just a bunch of people putting money into something they don't really understand in the hopes that it will go up or provide instant cash flow in the form of dividends every single month. This sounds more like speculating than true investing. Let's also take a look at an income ETF like Q Yield, which has consistently been rewarding shareholders for the past 10 years with monthly dividends versus a more growth-oriented ETF like the QQQs, which grab the most innovative companies of the NASDAQ 100. So, dating back to 2013, 10 years ago, Q Yield with dividends reinvested would have seen a $10,000 investment grow to $17,000. That's an average annual return of 6.12%. But if we had just left our money in the cheaper expense ratio fund of the QQQs, we would have seen $10,000 grow into $46,000, a return of nearly 17% every single year. This is because of the call options that income ETFs do. They often deploy the strategy, and that's going to be stunting their growth. Plus, we're also getting to avoid taxes if we just buy and hold versus dividends. Those are taxable every time they're distributed outside of a traditional retirement account. Also, just racking up enough shares of the QQQs, you could just do options trading yourself if you really wanted to. But I totally understand options trading isn't for everyone, and some people would prefer to pay others to do it for them, which is why these high yield income ETFs could have a place in some people's portfolio, especially those that are in the wealth preservation mode of life rather than the wealth accumulation mode of life. Guys, last month I didn't make $8,000 in dividends, but I slept very good at night knowing my investments were in sound and safe companies. And I know my time to shine is just on the horizon, if I'm patient. Check out the recent video I just put out on how much I make in dividends right here. I know this might be a controversial topic, but again, I'm not here to get you to agree with me or like me, but I'm here to make sure you're asking the right questions and growing and protecting your wealth. Any comments or questions, let your brother know in the comments below. As you hit that like button, for my Collect Cash podcast listeners, make sure you leave a 5-star rating. Thank you to all the Patreons who get access to my full 6-figure portfolio and weekly stock trades. And I will buy, stash, and collect cash you on the next one.